The previous video was an orientation for emerging importers and exporters with entry-level knowledge and language of the international trade. It is commonly referred to as Incoterms, which means it is international commercial terms. The International Commercial Terms, or Incoterms 2020, helps the seller and the buyer with the following: obligations. Who does what between the seller and the buyer in terms of the logistical value chain. Delivery, the point where goods are delivered for E terms, F terms, C terms, and D terms. Risk, where does a risk pass on from the seller to the buyer in the logistics value chain. And the fourth thing that Incoterms 2020 covers is costs. Where does the seller's cost end, and where does the buyer's cost, in logistics cost, where does it start? Today's video is aimed at orientating the emerging importer and exporter with the entry-level knowledge of customs and VAT requirements in South Africa. The Customs Control Act of 2014 requires importers and exporters to register with SARS in South Africa, the South African Revenue Service. The following people are required, or the following persons are required to apply for an importer or exporter code: a natural person, a juristic person, that means a company or a business, an association, and it includes foreign importers and foreign exporters that can apply in South Africa for an export or an import code, provided that the foreign importer or exporter nominates a South African company as their registered agent. The South African Revenue Service may refuse to register an entity as an importer or exporter if their tax affairs are not in order, there's a conviction or an act of fraud or dishonesty in the business, or there's a record of non-compliance. Once an importer or exporter is registered with SARS, that importer or exporter receives a customs client number. The following is excluded from obtaining an importer's or exporter's code. If a natural person that's located in South Africa, if that person either imports or exports up to 3 transactions per annum with a less than 50,000 per transaction, and as long as those goods are for private use, that means they're not for resale, then that particular individual doesn't have to have an importer or exporter code. The passport number, the identity number, or a tax reference number is actually used to declare for customs clearance in South Africa. Now, the starting point to obtain an importer's or exporter's customs code in South Africa is your business registration number, which is a starting point for all businesses. The first place that you go and register a business is with the CIPC, the Companies and Intellectual Property Commission. And so once you register there as a company or a closed corporation or a business trust or a partnership, you would receive a business registration number. The next step is to obtain an income tax number from SARS. When you've got the business registration number and an income tax number, with that, an entity or an individual can apply to SARS for an importer or exporter's code. The form that is used for the application for an importer or exporter code is referred to as the DA-185, and the DA-185 requires you to complete business or personal particulars, your banking account details, your income tax number, and at this point, if you have a VAT number, your VAT number is required, your PAYE details, your pay as you earn details, the nature of the business, the particulars of the individuals or directors in the company, and a whole list of supporting documents that has to be submitted with the DA 185. Currently, the process is a manual submission of the DA 185, but we're not far from the day when the application will be done via online as an e-filing application. Now, together with the DA 185, the other document that you also have to complete is the DA 185 4A1, and that is for the registration as a importer, and a DA 185 4A2, which is registration as an exporter. Now, after this point, if you don't have a VAT number, then you can apply for a VAT number, and obviously you're going to go back and amend your customs application, inserting your VAT number. And thereafter also, once you start to employ people, you can now apply for your PAYE number, your unemployment insurance fund number, and your skills development levy number, and that can come later in the process. Now, from a customs perspective, the documents that are required for you to export or import after you've obtained your customs exporter or importer code is, first and foremost, the exporter or the importer requires a customs broker or a freight forwarder, or the other word that used to be used was a clearing agent. The importer or the exporter has to give the clearing agent an instruction. That's called a clearing instruction. Secondly, the other document that's required to declare a customs declaration is an invoice. Then you need the transport document, either the sea freight transport document, which is a bill of lading, an air freight document, which is an airway bill, a road freight document, or a rail note. You might also require certificates of origin, permits and certificates that are required either to import or export the goods, packing lists if the consignment consists of multiple commodities or goods, and lastly, the essential document that's required for trouble-free shipping, and that is literature, product literature, what the product is. Now, there are other matters of importance that importers and exporters need to be aware of, but you don't have to be the master of being able to interpret it and apply it. You need a clearing agent to help you with that. The other matters of importance is tariff classification, and that means everything that you import or export has a code. When you know what the code is, and you know what the duties that are payable against that code. I'm going to have a separate video that's going to show you, or going to orientate you on tariff classification. The other important thing that importers and exporters need to understand, and that's rules of origin. How do you determine where the goods were made? I'm going to have a separate video showing you rules of origin. The other important thing that importers and exporters need to be aware of is customs valuation. There's a whole string of costs in international trade. Where in that whole string of costs do you stop and say, this is what the value of the goods is against which I will pay the duties and the VAT? I'm going to have a separate video that will cover customs valuation. And then the other thing that is important for importers and exporters to understand is customs procedures. And that too will be a separate video that will help you to understand customs procedures. Now, all four of those things that I've said to you, that you need to have a basic understanding, but you need a forwarding agent or a customs broker to help you those things. And the customs broker or the forwarding agent will help you with tariff classification, with customs valuation, rules of origin, and also to communicate to SARS electronically, and that is through an EDI process. freight forwarders and customs brokers have a system that they can talk to customs and receive the response message back from customs. And freight forwarders and customs brokers can also help importers and exporters with estimate costs. What would it cost to move a consignment from South Africa to another part of the world? What would it cost to bring goods from another part of the world into South Africa? And obviously, freight forwarders charge a fee to do or provide that service. The nice thing is that most of the freight forwarders belong to an association called the South African Association of Freight Forwarders, and they're governed by a code of ethical conduct. But you need a freight forwarder or a customs broker to help you with these things that I've just mentioned. Now, the freight forwarder or customs broker is basically one and the same thing, will also help the importer or the exporter to assess customs duties and taxes. Now, customs duties are meant there to protect the local industry from cheap imports, and it is the industries in South Africa that determine whether a particular tariff code has duties or not. It is industries in South Africa that actually make an application to ITEC, the International Trade Administration Commission, for the increase in duty on a certain tariff heading, for a decrease of duty on a certain tariff heading, or removal of duties from that tariff heading. And obviously, the duty rates are governed by the World Trade Organization. Every tariff code has a ceiling rate as to how high a country can import duties on that tariff. If goods are dumped into this country at a ridiculously low price, then there are other mechanisms to control that, and that's called anti-dumping duties. And ITEC, which is the International Trade Administration Commission, is also responsible for that particular aspect. Now, I want to give you a simple mnemonic for the purpose of understanding how duties and taxes work. The mnemonic that I want to give you is not 100% technically correct, but it will help you to understand the thinking behind duties and taxes. And this is what you can use to remember how duties and taxes work. I will state the mnemonic and then I will explain to you how it works. Duties and taxes are only aimed at the citizen of the country. It is not aimed at the foreigner, unless the foreigner consumed the service or the product in that country. I'll repeat that. Duties and taxes are only aimed at the citizens of the country. It is not aimed at the foreigners, unless the foreigner consumed the product or the service in that particular country. Let me explain to you what I mean. If you went overseas and if you stayed in the hotel, the fact that you consumed the service whilst you were in the country, therefore, you are liable to pay the VAT. Whatever food you ate in the country, you have to pay the VAT because you consumed those goods whilst you were in the country. But if you had purchased things like garments or clothing, because you want to bring them back to South Africa to use them. Now, when you purchase those products, you would have paid the VAT. When you, before you can depart from the country at the airport, if you went to the VAT refund officer and showed them your passport and all your documents that you paid VAT in that country, the VAT refund officer in that particular country will refund you the VAT. When you come to South Africa, see, I told you duties and taxes are aimed at the citizen, not the foreigner, unless the foreigner consumes that service in that country. So when you come to South Africa, then those goods that you're bringing back with you are subject to duties and taxes. In South Africa, as a returning tourist or returning resident, if the value of products that you bring is less than 5,000 rands, then there is no tax payable. If it's more than 5,000 but under 20,000, then the tax that you would pay is about 20%. If it's over 20,000, then you would pay the ordinary taxes in terms of the tariff heading. Now, that formula that I just gave you, or mnemonic that I just gave you, also applies for imports and exports. Let's assume you were importing these felt tip markers and you brought them from another country, and when it came into South Africa, you paid 15% duty on it. The reason why you paid 15% duty, because this is meant for the citizens of the country, and therefore it's for home consumption, and therefore it's liable for 15% duty. After you paid the 15% duty, now it's sitting in your warehouse and you're about to sell them to the local market. And then you have a foreigner says to you, you know, I need some of those pens. Can you sell me some of them? And so the foreigner places the order on you, and let's say you ship 100,000 of these pens out of the country. Then you can claim for the duty that you paid on these felt tip markers. The duty that you paid when you've imported it, that portion, that the 100,000 that you're exporting, you're allowed to claim for the duty. Why is that so? Because I said to you, duties and taxes are only aimed at the citizen, not the foreigner. The fact now the foreigner is going to use it, you will be allowed to claim that duty for the portion that you're exporting. The same applies for raw material. It might be the case you're making these pens and you don't have the technology to make the caps. And so you bring 1 million of these caps from a foreign country and you pay duty on them. Let's assume you pay 20% duty. And you pay the duty, you make the caps, and now you make the pens, and now it's sitting in your warehouse and it's ready for the local market. And then somebody from another country says to you, can you sell me 100,000 of these pens? Now, you've paid duty on this. Now, if you have all the documents in place up front, after you've exported this, the 100,000 of this pen, you're allowed to claim for the duty that you paid on the caps only. So that helps you to understand how duties and taxes work. Now, the next thing that as an importer or an exporter that emerging importers and exporters need to understand is the VAT, the value added tax. It's an indirect tax on the consumption of goods and services. And a business that has a VAT number is considered a vendor, and a vendor acts as an agent for the government in collecting VAT. That's what VAT is all about. Now, who should register for VAT? If your taxable supply, that means you're supplying goods and services that's in excess of 1 million rands per annum, then there's a mandatory requirement that you register for VAT. There's also a voluntary registration process if your taxable supply exceeds 50,000 per annum. Now, in South Africa, there is 3 rates of VAT. The first one is called standard rate, and that is you pay 15% on any product that you sell. The second is zero rated, and the third is exempt. Now, exempt means these are basic food items like dried beans, sam, maize meal, rice, brown bread, vegetables, fruits, vegetable oil, milk, eggs, bread flour, cake flour, and recently even sanitary pads are now become VAT-free in South Africa. Now, to understand how that works, let me demonstrate this to you. Assuming VAT is like a pot of money, and to keep the pot full, it's 15% of the GDP in this country. Now, in the case of exempt, what it means, remember I said to you, every person that's got a VAT number is an agent for the South African government to keep the pot full. So where there's an exempt rate in the list that I just given you, dried beans, ham, rice, bread, and so on. Exempt means you don't charge any VAT, so you're not bringing any money into the pot. But if you paid VAT on the raw materials to make the product that you sold, you're not allowed to take money out of the pot. So in an exempt, you don't bring money into the pot and you can't take money out of the pot. In the case of a standard rate, where you charge 15%, let's say we make shirts. To make shirts, we have to buy the fabric, we have to buy thread, we have to buy maybe labels, and we have to buy the buttons. When we buy those items, whoever we're buying from, we have to pay 15% VAT. And then once we make the shirt, and we're now ready to sell the shirt to somebody down the street, a retailer, and then we charge the retailer 15% of the VAT for the complete shirt, including the profit, our profit, and so on. So when we charge the retailer down the street 15% VAT on the shirt, that's called output VAT, our invoice to the retailer. That means we're bringing money into the pot. And for the VAT that we paid on the buttons, the thread, the fabric, and the labels, those VAT we're allowed to take out of the pot as a VAT vendor. And the reason for that is that VAT is charged at each stage of the production or distribution process. It's proportional to the price charged for goods and services. And so we come to the third one, which is zero rated. Zero rated means that this shirt that we made, we are exporting it to another country. And the South African government allows us not to charge the foreigner any VAT. Remember, I've given you the mnemonic. Duties and taxes are only aimed at the citizen, not the foreigner. So when you export the shirt, you don't have to charge 15% VAT to the foreigner. That's what zero rate means. So in other words, you're not bringing money into the pot, but you paid VAT on the thread and the button and the fabric and even the labels. You're allowed to take money out of the pot for those raw material VAT that you paid. That's called input tax. Now, obviously, the South African government want to make sure that if you say that you're exporting the goods, that it is actually exported and you're not pretending that you exported and that it stays in the country. And the reason why you're doing that is because you want to zero rate it, not pay the VAT, but still take out money out of the pot. Now, to manage that risk, the rules of VAT state that if you want to zero rate your export goods, then the Incoterms has to be C or D. In other words, you have to pay for the freight. You gotta pay for the freight. So that is proof, and do the customs clear in South Africa, the export customs clear, that is proof that the goods left the country. Or if you want to use F terms for sea freight and air freight, then the exporter has to ensure that he does the customs clearance and he delivers the goods to the port or to the airport. If you're selling E terms, in other words, the foreigner is coming to your door to fetch, then you've got to charge the VAT at a standard rate, that's 15%, and the foreigner, once the goods goes to his country, from his country, he can apply for a VAT refund, and that will take him up to about 90 days to get. Now, the reason again why the South African government or governments around the world allows exports to be zero rated is because every government in the world wants you to export, because that helps the government to bring foreign funds into the country. As an exporter, you are an asset to the country. You bring foreign funds into the country. As an importer, you're a liability because you are incurring debt to the country. So to make South African products competitive on the world market and to take out the duty that you have paid from the product and to take out the VAT from the product to make it competitive, that's why on exporter products you can remove the duty, you can remove the VAT, so that our products become competitive. At the same time, when we become competitive, we help the government to balance the books in terms of foreign debt and trade. A simple version of what the government's trade book looks like. Imagine you have a spreadsheet, and on the left-hand side, there's two sides to the spreadsheet. On the left-hand side, you've got all exports, and that would be the income of a country. On the other side, that is imports, and that's all expenditure of the country. So on the left-hand side, which is your income or your exports, you would have all the different currencies, your dollars, your euros, your pounds, and so on. And on the right-hand side will be your imports, or that's the expenditure of a country. And you would have, again, dollars and euros and whatever other currency. At the end of the month or every quarterly, when you balance the books, if the exports are more than the imports, then the country is said to have a trade surplus. If the imports exceeds exports, that means the country owes other country more money, and that's a trade deficit. And when a country has trade deficit, it's got less foreign money in its reserve to honor its debt. And that country therefore has to go and borrow money from the likes of the World Bank, the IMF, and the International Monetary Fund, or the World Bank. So I hope this video has helped you to understand how customs duties and VAT works in South Africa. In the other videos still to come, I'm going to show you some stuff on tariff classification, customs valuation, rules of origin, and customs procedures in South Africa. Thank you. Bye.